Hey guys, we're back again with another vendor spotlight, and I am really excited about this one. I am here with the hard money lender who helped me purchase a $525,000 house for just $18,000 out of pocket. So I'm here with Neal Wolf. Neal Wolf, why don't you tell everyone a little bit about yourself and how you got started?
So thanks for having me, Aaron. Neal Wolf with NorthCoast Consulting Group. I've been in the real estate finance game since probably started back in 1998. Been the mortgage broker, mortgage banker. 2014, I've really started to focus on, private financing and short-term bridge lending. And, we started with a very small group of people, and we've built it up to a tremendous book of business and quite a portfolio of investors. I've owned and flipped several homes myself, been involved with managing and landlording hundreds of units as well. Probably been involved in close to 10,000 transactions over the course of my career. So, I don't want to say I've seen it all. I mean, the fickle thing or the funny thing about the real estate industry is, it's ever evolving. I mean, I've been through 2000, I've been through 2008, I've been through 2012, 2014, 2020. Every little dip in the market, has its own little kind of nuance to it, and you have to be able to adjust. So, I've been through a lot, I've seen a lot, but I don't want to say I know it all. But I'm going to do my college best try here to answer as much as I possibly can here. So
no, I love it. I love it. We met, gosh, what was it? Probably 3 years ago or so at the Greater Cleveland Rehab meeting.
Yes.
And what really piqued my interest is you provide hard money, but you do it in a slightly different way than I think anybody else. I don't think I found any other lender who offers what you do.
Yes.
So why don't you tell everyone a little bit about what that is?
So you're going to see a lot of these institutional lenders and financiers, they're all going to be kind of lending the same way.
Yeah.
Where they're lending off of a percentage of the purchase price, or they're lending off a percentage of the overall cost of the project, capped by an after repair value. The Lima Ones of the world, the Corvettes of the world, I could go on and on and on and on. Everybody kind of works off of a certain platform where, if the purchase price is $100,000, you need to bring a certain percentage down, and then they're going to want to see that you, basically start your own rehab with your own money and do a reimbursement model. The private fund that I basically vet for kind of looks at it a little differently. I mean, we've been lending, they've been lending since 2007. I basically kind of partnered up with them in 2014. And they're basically lending off an after repair value. So, I mean, in theory, if you're paying 30 for a house and it has 30,000 worth of rehab and the ARV is 100,000, in that model, they could lend up to $60,000. And depending on, your expertise, your liquidity, your credit scoring, your overall real estate resume, we can get you up to 100% financing in a transaction like that. So it's definitely different from the way that these institutional and larger lenders are kind of operating.
Right. And for anybody who doesn't know, ARV means after repair value. And it's
Correct.
basically what the property could sell for at most when it goes time to sell. So you're basically taking 60% of what the loan to value, the LTV is. And
ARV.
You're right. Giving 60% of the ARV and loaning that out. But you'll do 100% of the purchase. And how much of the rehab will you fund?
I mean, every investor and every transaction is unique. I got a book of clients of, hundreds and hundreds and hundreds and hundreds.
Together we've worked with a ton of the same people.
So, I mean, everybody's situation is unique. Every project is unique. I mean, so for instance, if you're coming to me with a transaction where, the purchase price might be 30 and the rehab budget might be 60, but the ARV all lines up. I mean, there's no way that we're going to. We want to be even with the rate at which the project is going and the amount of money that's lent out. We don't want to be overextended. Obviously, sometimes we make exceptions for our better borrowers, that have established a track record, pay on time, pay things off. They're dotted and crossed, everything lines up. But, for your starting investors, I don't want to say, that every transaction we're going to be able to fund you fully 100%. I mean, everything's got to be evaluated. We got to make sure everything lines up, your rehab budget, your comps, got to make sure you get the credit score, the liquidity, and everything lines up. So, I mean, we can lend up to certain amounts, but, we don't always want to, overextend ourselves there.
Right. You like to be on the safe side, of course.
Yes.
So if I were to bring with you, we've worked together on multiple transactions.
Yes.
I've sent multiple of my buyers to you, and it really does. This product works, and it's different. And for me, I think one of the biggest the benefits of it is the amount of cash out of pocket.
Yes.
So how much out of pocket am I looking at?
Well, I mean, again, unfortunately, I can't give you a specific answer to that. But I mean, on a deal-by-deal basis.
Yeah, in a typical bridge loan, I'm going to come in and they're probably going to want 20%.
Yes.
Or at least 20% down, right? And then maybe you got these other hard money lenders who are at 15 or so. Should I expect to bring 15% down?
I would say in analyzing probably the last 20 or 30 transactions that I've done, the amount of money that somebody has to bring to the table is minimal. I would say it's probably less than 10% of, what we're willing. So basically, when somebody gets approved by me, I'm going to tell them, look, this is the loan amount that you're getting, and this is how much we're wiring to closing. Now, in relationship to that, to the purchase price, is kind of where you're asking about down payment. Exactly. So I would say that the last 20 or 30 transactions that I've closed, they've brought less than 10% down.
Yeah.
So, and some even less, and some are even getting money at closing. But I mean, again, every project needs to be evaluated. Every borrower needs to be evaluated. So it's not a finite box. I mean, it's a forever kind of fluid moving type of product, which is good because I'm definitely different from the industry norm where they're in a box. I mean, they have institutional investors and loan committees that they got to answer to. You are bringing money to close, period. I mean, there's no getting around that. It's either you're bringing, 10 to 15% of the overall project cost, or you're putting 20% down to the purchase price. And then you're working a reimbursement model in the rehab budget, that they are set in stone, where I am, forever fluid, if you will, to project to project.
Exactly. And I think that's what makes the most sense. We all know that in real estate, no two deals are ever alike.
Absolutely not.
And I say it all the time. One of the reasons I love investments is because there should always be a creative way to close the deal.
Yes.
When you get into residential and you're selling those types of properties, you're dealing more with the Franny and Fetty products. And so there is a box that you have to fit within. There's certain documents, certain numbers that absolutely you have to hit, or there's no loan. It's very black and white.
Right.
And in the investment world, it's just not quite like that. There's always a creative way to pull other things in.
Well, I think, in the investment world, as you know, speed kills deals.
Oh, yeah.
Your ability to close matters. We're in a business where, we're an assignment of an assignment of an assignment, and, how much work did that third assigner do? Did they forget about that $1 million IRS tax lien that's going to blow up the deal that we don't know about? Right. So, it's just a matter of proper due diligence, making sure the comps are there, especially in this market now. I'm sure it's definitely unique.
Yeah.
Certain properties are moving quick. Other properties are sitting stale, so you just really got to do your homework right now.
Yeah, Cleveland's market is a little crazy right now. And I tell everybody, one of the biggest tips that I have for any investor is, especially if you're new, to stay close to home. Stay in your own backyard, at least for the first few, because you need to get a feel for what that looks like, or at least stay really active in other people's transactions so that you can get an idea of what that market looks like. Because you're right. Right now, there's some single families that are back to selling at an above asking price very, very quickly. And then you've got other properties that are just sitting there and nobody actually knows why. It's a wild market.
It's crazy. I had a property go in a day. Yeah. I had a property go in a day, 10,000 over ask in the last 30 to 60 days.
I put up a duplex that it had 10 offers at or above asking price. It was on the west side, 50% occupied, at or above asking price. And we were listed on the higher side. And it just flew off the shelves. It just depends.
This market is really unusual. But then again, you'll have another property that's in a decent area sit for a couple of months. Is that normal? I don't know. I guess you'd have to kind of look at the historical market times associated with that particular address.
Right. And, I actually just talked about this in a class I taught, teaching agents how to work with investors. And one of the things I talked with them about is the closing time frame. Like you said, I think in residential, like 30 to 45 days is expected. Right. And in investments, at least in the Cleveland market that I'm familiar with, if you're selling an investment property and your closing time frame is over 2 weeks, your offer is significantly affected.
Yeah.
So when it comes time to close, tell me a little bit about that closing process. Do we need appraisals? How quickly can you close? What does that look like?
So that's fantastic. So that's another thing that kind of separates me from everybody else. I mean, we don't have the layers of third-party things that you might see from an institutional lender, where they might want to see a third-party inspection report, or they might want to see a third-party appraisal report. We basically do our own in-house comping. I mean, oh boy, I can't even begin to, I don't know how many transactions we've closed. I mean, we have our own in-house pool of comps. So we do all our own internal appraisal evaluating. So right off the rip, you're saving the time of not having to go through an appraisal, by using the sources that I use. I mean, so you're able to strip out a week, depending on how competent the title company.
Money.
Yeah, exactly. Depending on how competent the title company is. I mean, I've closed the deal as fast as 3 days.
Oh my gosh.
So, I mean, I think
how did title like that?
Well, I mean, I think that deal was a resurrection of somebody else that blew it up, and I took over and got it wrapped up. But, usually it's safe to say that, depending on, again, on which title company, the only thing that would really slow my transaction down is a survey, is about it. And then how quickly the exams come back. I mean, depending on sometimes the counties that you're working in there, they tend to be on the slower side. I'm not having any real issues with Lake Geauga and Cuyahoga, but, when you go farther east and farther west in some of these smaller counties, the turn times, might take a little longer to close. But, for the most part, we're knocking deals out in 10 business days. Unless there's some kind of an issue, or the close date needs to be pushed out further. I mean, let me give you an example. I got a contract date for the 7th of April. We're ready to close now. So we're trying to see if they want to close early. Mm-hmm. So, I mean, that runs into, that happens all the time with me, that we're able to close earlier than the contract date.
Wow.
So
if I'm a new investor or new to Cleveland market or just anywhere, and I wanted to use your product, what kind of documents are you going to need from me?
So, a great question. So basically, I would like to see a personal financial statement. I'd like to see what kind of liquidity levels you got. Because, I mean, again, you're going to be carrying a property that's not generating any income. Mm-hmm. So I need to make sure that you could function and then still make this payment. Depending on what your scenario is to exit out of this loan, whether it's a flip to sell to market or to keep as a rental, I'm going to have to do a deeper dive into your credit report. Ideally, I'd like to see a 680 credit score or higher. We might be able to, massage that a little bit if your intention is to flip. But if your goal is to keep it as a run, we got to make sure the credit's intact. I'd like to see a copy of your tax return. Just want to see, that you don't owe the government $1 million, because I mean, that would affect the first lien position on the property, if the IRS got in front of us.
Right.
And then I also want to make sure that you got an LLC set up, that's set up and registered in the state of Ohio. So I deal with a bunch of people that are in California, Florida, all over the world. Actually all over the United States, and they have entities that are set up in other states. That's fine. You just need to make sure that you have them registered in the state of Ohio as well to do business. We'll need the EIN number, operating agreement, that kind of stuff. And then again, depending if you're new or a seasoned vet, I'd like to kind of get an idea of the team that you have around you. Who are you working with over here?
Right.
If you're in California, who's doing your work? Who's your property manager? Who's your realtor? Who's the title company that you're working with? I mean, because if you don't have the right team around you,
right,
you might as well just take your money and set it on fire.
You're just trying to set them up for success, basically.
Exactly. I mean, I've seen disasters. I mean, myself, unfortunately in real estate, there is no college for it. You have to learn by theory. Well, not theory. I mean, by actual, rolling up the sleeves and diving into it. I've made plenty of mistakes that cost a bunch of money, and I try and save those mistakes from my clients and to make sure they don't make the same mistakes that I did in the past. Right. So
we keep talking a little bit about the institutional money and what you offer. Can you describe for me what you feel is the difference between the two?
Well, the institutional money, the reason why they have these guidelines, and at least this is my assumption based on, my experience in the mortgage banking industry, they may or may not want to package these loans up and sell them off. And when you're doing that, they want to see a specific box and a specific set of documents. The funds that my source uses are local. They're private. none of the loans that I'm doing are going to be bundled together for securitization purposes. So that is probably, we're basically allowed to make our own set of guidelines that we feel comfortable with. But when you start, breaching off and bridging over into this institutional market, that's when everything goes sideways. I mean, you have to, when you have your own money, you can do whatever you want. But when you're borrowing somebody else's money or using the bank's money or using life insurance companies' money or hedge funds' money, they have a guideline and a checklist of everything that you need to adhere to their guidelines, or you're not getting any money from them. So,
right. That's a really, really good point. So wrapping the whole product up, you don't need an appraisal. You'll do 100% financing. You'll close in 2 weeks. Why wouldn't anyone use your product?
That's a great question. I mean, again, it all boils down to the deal. Yeah. I mean, the deal is everything. You're not offering a product that people who are looking for long-term financing should come in. You do offer some long-term, but that's really just not your bread and butter. I'll be honest with you. There's more work that goes into the 30-year fixed financing than the front end stuff. It's the reason why I don't do Fannie and Freddie stuff anymore. It's just too much time, too much energy. The margins aren't there. I mean, you got to have a pipeline a mile long, of purchases and cash out refis to kind of, pay the bills. I'm able to pound out 20, 30, 40, 50 transactions a month, no problem. And then as a courtesy and basically kind of completing the circle of life with my borrowers, I do offer the 30-year fixed financing. I mean, if they're having trouble like working with their normal bank, I offer a DSCR product where we're basically,
and DSCR is
a debt service coverage ratio product where they're basically using the rent that the property generates to figure out how much mortgage the property
how much income is it bringing in.
We're looking at tax returns. We're solely basing the mortgage amount off of what that property can afford based on the rent that it yields.
The performance of the property.
Exactly.
Awesome. I want to backtrack for a second. You said that you only closed in LLCs. What do you think is the benefit to closing in an LLC? Even any investment property. What's the benefit? Why should someone close in an LLC?
Unfortunately, I'm going to be opening up some of my failures as a real estate investor. I mistakenly, should have never done this one. Basically got financing in my
Tell me the dirt.
Yeah, we're getting there. We're getting there. I had a rental property that I put in my name personally, and unfortunately went sideways on me because it was back in the 2008 financial crisis. And, it was just, it was a nightmare back then. It was real tough. A lot of lessons to be learned from there. Unfortunately, when I went to drive by that property a few years later, I kept driving up and down the road and couldn't seem to find the house. The city had demolished it. So, wow. And then that yielded a judgment against me personally, which I had to pay back. So, there's a variety of reasons to keep your property in an LLC, for tax purposes, liability purposes, and then, protect yourself from the city and, building departments potentially. I mean, not that I'm trying to do anything, not by the book, but, if that was structured a different way, I probably wouldn't be able to maneuver differently through there. So
why does it have to be in Ohio?
So the reason why it has to be in Ohio, the LLC, is, God forbid, the property goes sideways and it goes into foreclosure. We want to make sure that we keep the foreclosure process here in Ohio. If you have an LLC that's in California and it's registered in California, we would have to fight it out there. So we make them register in the state of Ohio. So God forbid, again, they go sideways and we got to foreclose. We keep all the laws, all the court hearings, everything here in the state of Ohio, instead of having to go on the other side of the United States and have to fight this thing out legally or in court or whatever. That's why we want everything in Ohio.
Yeah. So tell me a little bit about, what do you think is happening in the Cleveland market right now? How has business been for you? Is it growing? Is it volatile? Tell me all about it.
Well,
I talked to a commercial lender yesterday and I asked him the same question. And it's funny because I think it depends on what realm you're in and what aspect, what niche in real estate you're in. For that lender, business was definitely different than what I would recognize as the Cleveland market and what I'm seeing. And for a residential agent to a commercial agent, I think it's different. So what are you experiencing right now?
It's interesting. My heart goes out to the Fannie Mae broker right now. If you don't have a good, solid purchase referral base or getting decent leads to basically do cash out refis, before it was like shooting fish in a barrel. I mean, who can't sell a 2% interest rate? Now you find out who the real players are from the people that were just faking it. So, I'm doing fabulous. I mean, the phone's ringing off the hook. I mean, it's taken years for me to get here and build out a base of clients. It's great. I mean, but I'm in a different type of market. I'm not dealing with Johnny and Sally Smith buying their first home anymore.
Yeah.
I made that transition many years ago. I'm like, look, why am I doing one loan for one person and then they might do a loan in 5 to 7 years? I'd rather deal with a guy that's buying 30 or 40 houses, get 30 or 40 loans and call it a day. That's how my business has always been. So, I mean, I have clients that I started with one house and then 187 loans later, they got 300 houses.
Right.
I'd rather deal with those type of people, because again, they're not focused on, the interest and the payments. They're looking at it more, how much rent can this property generate and what's my spread? So they're looking at it more analytically than black and white, and there's not a lot of emotion involved in it. It's strictly investment. There's so much money sitting on the sidelines, and there's so many people that live outside of the Ohio that are looking for that cash flow and that value add. California, I mean, I would say probably about 30% of my clientele are from California.
I could say the same thing. Nothing's wrong with California, but Cleveland, our price points are lower, our cash flow is higher. We might not have some of the cap rates that other places do, but you can't beat buying a $1,000 duplex that's making you $2,000 a month.
Look in San Francisco.
$100,000
Look at San Francisco. I mean, if you have a bungalow out there that you and I would see in Garfield Heights that we would pay $65,000 for, that same one out in San Francisco, $650,000.
Yeah, it's wild.
It makes no sense. I mean, it's very difficult to make anything cash flow out there.
Yeah. And for anyone who's not from the Cleveland market, he's not joking when he says you can buy a bungalow for $65,000. That is a market price for something over there that you could typically fix up and sell for what, 100 or so?
Yeah, I mean, it all depends on your finishes.
Yeah.
I mean, I've seen stuff transfer, even higher than that.
Oh, yeah.
So, I mean, again, you get so much bang for your buck out here. I mean, in Ohio is a very diverse, it's got all kinds of regions to it. I mean, if you could do those higher end flips down in like Columbus. I mean, you could still do those higher end flips up here in Ohio. I mean, in Cleveland. I mean, in Detroit Shoreway and those areas. You just got to be careful. I mean, sometimes you get in those historical renovation districts where you got to do exactly what they say or else.
Right.
So,
but that's good. You just reminded me. You and I worked on a deal together. I wasn't the actual purchaser on this one, but one of my clients was, and we purchased a house in Euclid. And Euclid is not typically known for being a higher end market. I think most houses would transfer somewhere between 100 and 150 at max. And when we ran the comps on this one, it had 5 beds and 5 baths, which is unlike anything else in that neighborhood. For sure. I mean, I think the whole city of Euclid, it might be the only 5 bed.
So, I mean, right off the rip, you're running into issues because you're dealing with a white elephant out there.
Exactly. So how are you comping it? So when I comped it for them, I was like, look, 225 is as high as I can tell you that I can promise you. And I typically like to give 3 different values. This is the this is the price I can promise you. This is the price we're going to expect, but this is the price we're going to hope for. So that price I can promise you is typically below. We have another number we're expecting, but I can guarantee you're going to walk away with this number. And the best I could give them was 225. So they went in, I helped guide on all the finishes. You provided the loan products. They were able to get in a little bit below. Similar problem, though, is how much money are you funding for this renovation? Because it was down to the studs. It needed everything. But there really is, what is the ARV? We don't know. And I think you based everything off 250. So we kept the renovation. I think it kept the renovation to around 75 or so. And they purchased it around 90, I think.
Well, that sounds like a good score.
And we sold it at 305.
Wow. Damn. Okay. All right.
Yeah, we sold it at 305.
See, you don't have to go spend $25,000 on a weekend out at Fortune Builders. All you got to do is listen to your podcast.
Well, thank you. Yeah, no, we sold it. It was I think $120,000 higher than the highest sale in that neighborhood. Like that
that's
vicinity.
incredible.
It was wild. But
was that a cash buyer or was there financing involved?
No, there was financing.
Wow.
There was financing. But honestly, the price of what happened, and I like the reason I say I can guarantee this price, and this is what we can expect, is because I like to back it by what I can fight in an appraisal. And because of the size, the price per square foot was actually far below what other houses have sold for. So you can't tell me it's not worth this much. A, there's nothing else for you to compare it to. And B, it is priced, it was probably still $20 to $30 a square foot lower. You can't tell me it's not worth this.
That would be a very, oh boy. I mean, that would be a tough one. I mean, you know, again,
it would.
I mean, usually you want to be able, when you're getting houses appraised, you want to have it in bracketed. You want it to be in between or near the high end and the low end. So, I mean, if you're looking for like 130,000, you want to have a comp that's 140 and one that's like 120. And that one's going to probably get you through appraisal review with very little hiccups. But I mean, again, you know, good job with that one. I mean,
well,
wow.
You and I have worked together with that buyer a few times, and I think they like to find the properties that require me to work the hardest, because everything, I'm like, we're going to break the market again on this one because there's nothing else like it.
That's not a good model to basically try and set the sales record for every zip code that it's in.
Hey, it's fun, and we've been doing it since. So we're actually in the process right now looking for the next flip that makes sense. So we definitely need to find one out. We just wrapped up 24 Lincoln. We just closed on
wonderful.
that one. Yeah. So moving on to the next one. Now, tell me a little bit about you as an investor.
Okay. You know, again, what I used to do and what I do now is completely different. I mean, again, you know, I'm not big into buying and, you know, being a landlord right now. So, I mean, again, a lot of the properties I mean, again, I work with a lot of the private sources and help them kind of unwind out of some of the projects that might have gone sideways for whatever reason. So I'm usually kind of bringing these properties back to life. Sometimes I put a tenant in there, sometimes I don't. And, you know, and then I work with, you know, various realtors like yourself, you know, in the area to, you know, try and move these properties. I mean, again, you know, if I was to start buying again and money wasn't an issue, you know, I'd be probably buying rental properties, 3-bedroom ranch slabs in the better areas with the best school districts. Because at the end of the day, you know, I went through that 2008 financial apocalypse. The properties that I had were in the worst areas, and I'll never make that mistake again. It's, you know, it's crazy that old adage, location, location, location. That's the only thing that matters. Because at the end of the day, you're going to get best rents, you're going to get value add, and you're going to get better tenants, and you should have not as much management, you know, going into these A+, B- areas.
Yeah, to be safe, it's smart to always buy the ugliest house on the nicest street is typically what they say. And if you're going to go for single families, then, you know, the school systems and all of that should be taken into consideration. They should.
I mean, at the end of the day, everybody has their own model that they feel comfortable with. This is the model that I would feel comfortable with based on, you know, my years of experience. But I mean, again, you know, there's plenty of people that I've worked with that have been incredibly successful, you know, whether they're buying duplexes in Cleveland or singles in Maple Heights or singles out in Toledo or Youngstown or whatever. You know, I have plenty of investors that have succeeded in all those models. It's just a matter of identifying it, make sure you got the right team around you, make sure the numbers all work, and just executing on that plan. The one thing that you want to make sure, especially now, is that you have access to liquidity on the other side. So, I mean, either you're paying with cash or you're using private financing. And if your intention is to keep, you want to make sure that you're adhering to the guidelines to get you that permanent financing. That is the big takeaway that I would take away right now with trying to build out a rental portfolio, is make sure you're positioning the properties that you're looking at to make sure you can access that private or the permanent money on the other side. Yeah,
that is a huge point right now, that if you own rentals, especially if you bought them within the past 2 years, if you have a balloon coming due in 2 to 3 years, you should be definitely reviewing your contracts, talking with your attorneys, because there's a lot of things happening with the banks right now.
Oh, yeah.
And if you're not making sure you're adhering to these guidelines, there's a good chance that these banks don't want to hold these 2.5% loans anymore.
Right, exactly.
And they're going to come back for them. And if you are, you know, 1 day late, that is recourse for them to take this back. So protect yourself. Make sure that you're staying on top of all of your contracts.
100%. The other thing that I would say is if your intention is to keep rentals, my strongest advice to you is to make sure that the property will easily and conservatively appraise over $100,000, because it's very difficult right now to get any type of financing on properties, especially one-offs, you know, under $100,000. Yeah. Good luck.
Oh,
I mean, unless you could qualify for Fannie Mae. If not, then you need to move on to the next property.
Yeah, I love that you brought that up. I can't tell you how many times I have had investors come to me and say, oh, yeah, I want to keep it low, like $60,000 or below. And while, yes, in theory, this low price point sounds great, are you really just bringing $60,000 to the table cash in order to close this?
Right.
Wouldn't you rather take that $60,000, split it between 2 or 3 down payments?
Right, exactly.
And purchase multiple?
Or use private financing and maximize the power of leverage and, even stretch that liquidity out even farther.
Yeah.
I mean, again, like we were talking before, my goal with all my investors is to maximize leverage and minimize their capital injection. That's the only way you're going to build a real portfolio if you're really trying to grow. Because if not, you got to go the old school method of saving up 20% every time you want to buy a freaking property. That's going to take you years. It might take you decades.
Yeah.
So
and it's hard for a lot of people because the moment they do that refinance and they pull that money out, it goes into their bank account and then a bill gets paid and auto pay happens. And where does that go? It disappears really quickly. And all that profit that was supposed to get rolled over doesn't get rolled over.
Right.
So on a larger scale, let's, a lot of people know that I flipped Snowberry. And that was a pretty large project for us. It was probably the largest deal that I've done with you. Let's kind of walk everyone through what that deal looked like.
Okay.
So purchase price on that, it was a 7-bed, 4.5 bath, and the purchase price was $525. But this thing was straight out of 1970.
Right.
I mean, gold wallpaper, orange carpeting.
Why did you change that?
I didn't. It's still there.
Fantastic.
We did keep in one of the bedrooms. It had animal wallpaper. It was lions and a tiger.
You got to keep that.
And it's my son's bedroom, and he loves animals, so we did keep it. But overall, we had to fully renovate every inch of this 7,000 square foot house. But I came to you and I said, all right, I want to buy this $525,000 house. How do I do this? And I think after all the numbers, I put the numbers together the other day. I ran the comps for you. And again, here's me breaking the market again. There's nothing updated that's sold in this area for me to comp. So I'm like, look, it has to sell for more than these.
Right, exactly.
Right?
Exactly.
It's really what we had to do. And I think maybe there's a little bit of you understanding and knowing my experience and trusting in that probably played a role into.
You're a real bulldog in a good way, fighting for value.
I mean, it was tough even with the appraisal when it came time for that. I'm like, look, this is going to be tough. Here's all the information I have for you. So with that, out of pocket for over a $500,000 loan, I did the math and it was, I can even pull it up, $18,000 or so is what we ended up paying for that.
Right.
So that even falls below your 10% that you were saying.
Yes.
But the numbers worked. You could see the value there. And we were
Yes.
just doing the purchase price on that one.
Yes.
So it was $18,197 was the actual amount that we paid out of pocket. Now, I think this conversation is fun. Now, I'm a realtor, of course, so I got a commission on that side, and the commission was actually just over $11,000. So out of pocket, I technically spent $6,947,000.
I mean, that's fantastic. I mean, again, for all the realtors out there that don't, get into the investor side of the business, this is something to consider. I mean, I don't want to use this term, but I'm just going to say you're double dipping on both sides.
Exactly.
But I mean, why wouldn't you? I mean, you're basically representing yourself.
Exactly. And in some deals, if you want a lower price point or something, you can eliminate that so that it strengthens the offer for the seller, but they've already agreed to it. Why would you leave it on the table?
Exactly. I mean, again, I don't know what goes involved into coaching up these realtors on building their business model or whatever. But I mean, not having some kind of a section of your portfolio that's investor related, to me, it's the perfect way to kind of balance out the market because investors are always buying. And when the market is tanking, guess what the investors are doing? They're buying all these properties up when there's blood in the streets. I kicked myself back in 2012 when I wasn't buying those houses in Maple and Garfield Heights for 10 and 12 grand because now they're worth 140,000. I mean, I wasn't looking at real estate the right way. I should have been looking at it. Okay, I'm paying 10,000. What can I get in rent there? Right. Okay, I could get 750 back then. Now you're getting 1,250. I mean, regardless of how bad the market gets, macro level, there's still not enough housing to, for the population in the United States. Yeah. And I mean, realtors need to listen to this. We're not taught how to work with investors. We are not taught how to have investment properties ourselves. So that training is crucial. And that's something I'm really passionate about this year.
teaching classes, trying to teach more agents how to work with investors and feel confident investing in themselves. But the model that you gave allowed me to do something most people would be too afraid to do.
Right.
So I bought a $500,000 house that needed a full rehab. That's not included in the 500.
Right.
But I was only able to purchase this house because I was able to do it for as little as $7,000 out of pocket.
Well, let's compare that to your institutional investor. In that same transaction, you probably would have had to put 10 to 20% down to the purchase price. I mean, that's anywhere between 50 and 100 grand off the rip. So, I mean, again.
And still have to fund the rehab.
Exactly. So, I mean, the thing that you're doing is you want to create a buyer base.
Yes.
These investors, if you could get them pre-approved with this private financing, I mean, you're creating a buyer base that, we could close just as fast as cash.
Right.
I mean, people say, I want to close in cash. I'll be honest with you. I mean, I got a lot of deals that are cooking where people are paying in cash. They're taking longer to close than the ones that need financing. I mean, it doesn't make any sense. So, I mean, yeah, it sounds sexy that somebody's paying cash for something and you see that big, frothy bank statement, but, they're unwilling to put down a non-refundable earnest deposit, which doesn't make any sense to me. I mean, if you're cash with no contingencies, put up or shut up. I just don't understand that. So,
yeah, my personal theory on cash, I mean, and everyone is, can be their own investor and do whatever they feel comfortable doing. But for me, if you have $100,000 to put down, why are you not buying 5 different properties and putting your 20% down on each of those 5? You're mitigating your risks. Now you've got it spread across 5. If that one property you just spent $100,000 on burns down, while you likely had insurance and you'll get that back, the income you were planning to generate isn't. The headache that you just created is 10 times the stressor, and you've got nothing working for you out of $100,000. Spreading that across. Now think about what they could do. If they come to you for 10%, I can buy 10 properties.
Right.
I just doubled the amount I could do.
Leverage.
Exactly. Because I was able to. Exactly.
But the key with that is, you can't go out and do that and pay retail for everything.
No.
You have to and you should be finding the right properties. Why would you pay retail for an investment property? It doesn't make any sense.
Oh, no.
Especially when you can find a property that literally just needs paint and carpet and that you could buy at a discount, and get more leverage against that to then balloon it out to permanent financing later. It's all about the power of leverage. I mean, look at these people out in California. I mean, basically what they're doing is they're taking the equity in their home, getting a massive equity line at 2%. That was a couple of years ago, buying 20 houses out here, and those 20 houses are generating $1,200 a month or $1,000 a month in rent. You're bringing in 20 grand to offset a 2% equity line payment. I mean, they're basically playing interest rate arbitrage with the equity that they have in their house. And they're basically, keeping the spread and having the depreciation. So,
but you are 100% correct. The fastest way to grow your portfolio is to use this product. At least I believe so, is to use a product like yours, something that allows you to grow. We decided to keep that house and move into it. And we did my husband did the work. So our rehab budget was a little bit less than most people would do. We actually only out of pocket spent $100,000 that we used a separate loan for. We didn't finish our master bath, but we did stay on top of, within that $100,000, mainly because I wanted to prove that I could use the network that I have. And in real estate investments and as an investor agent, my network is my value.
Yes.
So I wanted to show that I could flip this house for $100,000 without sacrificing quality. So we have hardwood hickory floors and we've got really nice vanities. We did all of these incredible things, but because of his sweat equity, which is key, especially with like your type of property, if you can put sweat equity in there, the amount of profit you're going to make is much higher. So all in. Now, we didn't talk about what the interest rates were. My payments over those 12 months that we were flipping it totaled about $72,000, which is high. It was a higher interest rate. What's your average interest rate?
It's 15%.
So 15%.
But I always tell everybody it's cheaper than having a partner. So, I mean, again, you could split the profits or you could keep them all. I mean, it's entirely up to you.
Exactly. But out of pocket, I spent $7,000. Throughout the course of it, I spent $72,000. But including that 72 and including the total I owed you back, for the purchase of $525 plus the $115 for the renovation, because I gave him 15% as well. We're sitting on $388,000 of equity now, and because we refinanced and it appraised at $1.05 million. So the fact that I was able to buy $1 million house that my family now gets to live in because I was able to utilize your product for $7,000 technically out of pocket. Like, that's mind-blowing.
Well, I mean, I did the same thing with my house out in, where I live. I mean, I paid $305 for mine. We got 100% financing. I came out of pocket, for the points in legal. I don't know, what was it, 12 or 13 grand or something like that.
Yeah.
But then I got a tax credit at closing to basically wipe that out. And then I probably dumped about $150,000 in cash in and out. Now that house I ballooned out of it quick.
Yeah.
I was in and out in about 4 or 5 months.
Yeah.
So I was able to kind of keep the interest expenses low. And then I, bought like an extra month of, not having to make a payment because of the way 30-year fixed mortgages work. I mean, that house should appraise now for like $850,000.
Yeah.
So, I mean.
You're not too far from me now, right?
Well, I'm out in Geauga County.
Oh, yeah, you're farther from me.
Yeah, it's all good, though.
Not super far because I'm in Pepper Pike. So
yeah,
it's not.
well, I mean, again, down the road. It's not too far. But
Down the road. Awesome. Well, if you had one piece of advice to give investors, I'm not even going to say new investors, but to give investors right now, what it would be? What are you seeing that is affecting people? What should people watch out for? How should they stay protected? What's your value add?
A couple of things. Don't chase the market. Don't get emotional about buying. Don't think you need to buy. Do your due diligence. Get your comps right. I mean, your comps are critical right now. Make sure that your comps are within 90 days because the market is shifting. So you want to know how the market is shifting as recent as humanly possible.
Thank you for saying that. I'm telling everybody, like if you want to take comps from 6 months back, you need to take at least like a 10, 15, 20% off the top of that because it's a different market.
Yeah, because I love when these people send me these comps from June. I'm like, look,
I laughed out loud.
Was this, yeah, and then, sometimes you have to, like for instance, on a 4-family or something like that where there's limited comps and, sometimes you have to go further back and farther out. But I mean, if you're trying to justify an ARV to me and you're looking at June of last year when the market was still kind of, I don't know, was it still kind of hot?
And it's a one-off.
I mean, that ain't going to work, man. I mean, you got to compare apples to apples. Make sure you're comparing a ranch to a ranch, not a ranch to a bi-level. Don't automatically assume that the value that you're going to get is the highest sales-breaking record sale. You can't assume that.
Right.
And
we didn't do that. We expected more, but you can't do that.
Right. The other thing is you got to have a solid team around you, man. I mean, if you don't have a solid team, realtor, construction guy, property management, title person, if you don't have that, you need to get that before you, start buying anything. Yeah. And I'm sure you have a nice network. I have a nice network. I mean, and I'm sure, my clients and your clients, we would offer them, that Pandora's box of quality people because, I mean, again, it's real easy to talk about the horror stories where, this contractor ran off of that money, then the new contractor from that contractor ran off of that money, and then that contractor of that contractor not only ran off of that money, but then put a mechanics lien against the property. I mean, you could see how it could blow up.
Right.
And then, you got to really vet your property managers hard, especially if you're not living in Ohio.
Yeah.
You can't drive by and.
What questions do you think they need to ask them?
I mean, again, what kind of properties do they currently have under management? Mm-hmm. If you got a duplex in 44108, you want to know that they have duplexes in 44108 that they're managing and not managing, the Four Seasons in Beechwood or Gates Mills, or they got one single vacation rental in Hunting Valley they're looking after. Right. You're not going to have the same clientele. You're not going to be dealing with the same types of problems. You're not going to be there's going to be more management over here, not over there.
I'll say one of my tips is to ask them how they handle their keys. I can't tell you, and this comes from my own frustration of showing apartments where I can't find a key. None of the tenants can't open any of their units. I ask this question to every property manager. How do you handle your keys? Do you have a master key? Mm-hmm. And of course, there's those one-off tenants who come and they change their locks. And I get it. There's nothing we can do about that. But if I'm showing a 12-unit apartment building and every door has a different lock and I look like a janitor walking down the hallway.
You got the hubcap and then anyway.
And it looks ridiculous. Why isn't there a master key system for this? Like you can have one key.
Or some kind of a fob or something.
Exactly. But I think as property management and as an owner, you should have a separate key for that door.
I never would have thought of that. I mean, I think of things more macro as opposed to micro like that. But I mean, again,
this comes from experience. I went to go sell a portfolio and the property management had no keys.
That's the biggest problem. Especially when you're trying to show houses, getting people in is the biggest problem is, is there a lockbox? Is there not a lockbox? Is it boarded up? Do you need to bring a crowbar and a screw gun to get the boards off?
Right.
That's usually the biggest problem is, showing some of these houses is how to get these people in there.
Yeah.
So
my piece of advice for everybody is if you have a rental property, there should be 3 sets of keys. The tenant should have a set of keys, the property management should have a set of keys, and you should have a set of keys.
yeah, that works for me.
It's the easiest problem solver. I mean, you're going to have one-offs, but come on, guys. Like,
Right.
it's a very easy fix.
Exactly.
To just have 3 sets of keys made and it costs you, what, 79 cents?
I'm actually going to go home and make just 3 sets of keys of my own house keys, just because I think that's such a fantastic
we have to do that
point.
too, just because I lose my keys. So now we just have the key fob blocks.
There
it's
you
just
go.
10 times easier that way. Yeah, so due diligence and just doing everything up front. I don't think enough investors compensate or calculate for the risk. Especially if you're newer, or maybe you're not new to investing, but you're new to flipping. Add to all those costs. Don't assume nothing's going to pop up, because the truth is our houses in Cleveland were typically built around the 1900s. Something's going to pop up.
Right. I mean, you bring up a fabulous point, because again, it was kind of disheartening when one of these flippers that I was working with didn't understand, that when he was going to sell the property, that there was going to be additional fees for selling, and he wasn't sure. He didn't know that he had to pay realtor commissions. And I'm like, okay, you just lost all credibility with me.
Right.
How do you not know this? And it's incredible.
So tell me a good rule of thumb. That's an awesome point to lead into this. What is a good rule of thumb for an investor to calculate for maybe their closing costs? Is there like a percentage of closing costs? Obviously,
on the front end or the back end?
On the back end. On the back end.
For a refi or a sale?
For a sale. Like on the front end, it depends on what the seller's signing up for. There's a lot of unknowns, and you can kind of adjust for just your half. But on the back end, they're going to pay their closing costs with the title company. They're going to pay a realtor commission of, 6,
just
7%.
Say 6-7%. Yeah, I'd take that off the rip. You got to factor in the insurance, any taxes that you're going to have to pay. Usually you're prorating taxes. So you're basically overpaying to give the buyer the credit. Depending on the loan size and the purchase price size, your title closing costs range anywhere from $1,500 up to $3,000.
Yeah.
I mean, based on the title insurance and maybe the lender endorsements that they might want, surveys and all that other stuff. Yeah. So 6%, 6 to 7% for realtor commissions. Just basically factor in another 6 months of taxes for that particular property. Any homeowners insurance you might have to pay, depending on, the goal, if you're not churning these properties over fast, you really got to really take a step back and is this really for you? Are you managing this right? Do you have the right people in place? It shouldn't take you 18 months to do a rehab. If you're doing that, you're losing money.
Yeah.
You need to blow this stuff out. You need to have it on the market in 90 days and have it sold hopefully in 90 days thereafter. You need to be all in from start to finish, ideally under 6 months. If not, what are you doing?
Yeah.
What are you doing?
So that's time frame wise. Now, what do you think? 10, 15% calculate on the back end?
Yeah, I think 10% would probably be a good number.
Yeah.
Because that should basically cover everything. On $100,000, I think $10,000 should cover it between realtor, commissions, title charges, taxes, homeowners insurance, and anything else that might pop up.
Exactly. So add that. And
if your number is 100,000, subtract 10, subtract then what you're putting in rehab, subtracting in the purchase price. And if that number isn't at least $15,000 or a certain percentage of what you're selling this thing for, why are you buying this house?
There you go. That was the easiest nugget. Everybody who you just heard it, just take those numbers. It's the easiest way to back out of it to make sure.
It's a top-down approach.
Exactly. Top down, make sure you're calculating for everything. There's going to be unknowns. Make sure that's factored in there somewhere. And that profit, ultimately what you're willing to accept in profit is up to you.
Mm-hmm.
I think most of my investors are looking for at least $30,000 typically to make it all worth their while.
Right.
And obviously you're including or trying to account for doing that in a quick time frame.
Yes.
Otherwise, that 10% is going to keep going up the longer you hold the property.
Absolutely, 100%.
Especially at 15% interest.
Absolutely. So.
Awesome. Anything else you'd like to add?
I think we hit all the nails on the head
here.
I think we did a hell of a job here.
All right, Neal. Well, tell everyone how they can get in contact with you.
So it's always good to text or email me because the phone's just ringing off the hook. The fastest way for me to get a hold of you is either shoot me an email at nwolf@nccgconsulting.com or shoot me a text at 440-364-9954.
Awesome. Thanks, Neal.
Thank you.